So let's take a look at how the pricing works for SFR portfolio loans. The interest rate is a result of adding the lender set spread to the Treasury rate. In our examples today, we'll stay focused on a 5-year term investment and the associated 5-year Treasury rate. Contrary to popular belief, the Fed doesn't actually set Treasury rates. I told you, Karin, we're going to talk about it. Treasury rates are set by market activity. When more market participants want to own treasuries, the rate goes down. This happens basically because those investors want to own the bonds so much that they're willing to accept a lower rate of return. They bid the price of the bonds up, and that drives the yields down. This is commonly referred to as a flight to safety. When investors feel the market is more risky, they want their money in the safety of US Treasury bonds and will pay up to achieve that. The opposite occurs when there is more confidence in the market. Investors are willing to take more risk in their investments, and the result is the flow of funds away from the safety of treasury bonds and into higher risk investments with higher returns. The flow of funds away from treasuries results in a higher treasury rate. Rates are influenced by activities of the Fed, but not determined. People most oftenly hear about changes in the overnight rate. So, recently, Karin and I were just talking about how the Fed decided not to lower rates in their most recent meeting. When the rates that they're talking about lowering or changing at all is they're referring to the overnight rate. And that's what the Fed can directly affect. When you dig into it, they're not even actually setting the rate. They're trading securities in an effort to set that rate. Perhaps an equivalent and even larger effect the Fed can have, though, on Treasury rates is through the control of the size of its balance sheet. This is, very similar to what we were just talking about funds flow in and out of the ownership of bonds. An increase in the size of the balance sheet means the Fed is purchasing more assets and is effectively putting more funds into the market. Sale of assets removes funds from the market. When funds are more scarce, the borrowers have to pay more for funds because they are in higher demand. This drives rates up. The reverse happens when there are more funds in the market. Lenders are in less demand because of the availability of funds, and rates get driven down. Doubling down on our previous statement that interest rates have high volatility, take a look at this graph. In presentation one, we noted a 1.6% spread over 3 years. Here, in just 6 months, there's a 1.2% spread in rates. And that's even without a structural change in the rate environment. The max 5-year Treasury rate over the last 12 months is 4.61%, where the min is 3.41%. Even without a major structural change in rates, there are substantial moves. This may drive strategy decisions as we consider timing of borrowing. Spreads are also a result of market activity, but are set by the lender and are far less volatile. The spread is basically a factor that the lender uses to control the profitability of their lending. Transparency of how spreads are set isn't always rampant, but generally spreads are a factor of these conditions: market risk, borrower risk, and loan structure. The one part of the spread we can affect is in our selection of the prepayment penalty. We went through kind of the different types of prepayment penalties in the last slide. Without getting into too much detail, a smaller spread is associated with yield maintenance, which can make an early payoff very expensive for a borrower. Borrowers pay a larger spread for full-term step down, i.e. 5, 4, 3, 2, 1, to make it less expensive to pay down a loan early. Factoring in all of this, the 4.02% median treasury rate plus an assumed 2.5% mid-range spread would result in an interest rate of 6.52%.